Welcome to The Explainer. Today, we're going to decode the visual language of the financial markets. We're going to learn how to actually read the stories that price charts are trying to tell us by understanding Forex chart patterns.
Really think about that for a second. What if price charts could actually talk? What kind of stories would they tell? Well, here's the thing. In a way, they do. Every peak, every valley, every little pause, it's like a word in a sentence that describes the constant battle between buyers and sellers. And our job is to learn how to read that story. So that brings us right to our first section, reading the market's story. This is all about getting down to the fundamentals of what these patterns are really showing us.
At their very core, chart patterns are just specific, recognizable shapes that show up on a price chart. You can almost think of them as historical footprints. Technical analysts use these shapes to try and predict what might happen next based on what happened in the past when a similar shape popped up.
But what's really going on here? These aren't just random squiggles. Not at all. They're a direct visual of market psychology. The collective hope, fear, and greed of every single trader out there. Each shape gives us a clue about where the balance of power between buyers and sellers might be shifting. Every story has a plot, and in the market story, there are really two main plot lines. Is the current trend going to continue on its path, or is a dramatic plot twist about to happen? This brings us to continuation versus reversal patterns.
And here are the two main categories, plain and simple. Continuation patterns, they suggest the market is just taking a quick breather before it keeps going in the same direction. Then you have reversal patterns. Now these are the big plot twists. They signal that the current trend might be running out of steam and is about to change direction completely.
Okay, so now that we know the main plot lines, let's meet the cast of characters. We're going to walk through some of the most common and recognizable patterns you'll see on the charts. First up, we've got the double top. It looks just like the letter M, and it's a classic bearish pattern. That means it suggests prices are getting ready to head down. It happens when the price hits a high, pulls back, then tries to rally to that same high again, but it fails. That second failure is a really strong signal that the buyers are losing control. Its optimistic twin is the double bottom, or the W pattern. This one is a bullish reversal signal, suggesting prices might be heading up. Here the price finds a low, it bounces, drops back to test that same low, and finds strong support. This tells us the sellers are exhausted and the buyers might finally be ready to take over. All right, let's look at a continuation pattern, the bullish flag. You'll see this sharp, strong move up. We call that the flagpole. It's followed by a brief little consolidation where the price drifts down slightly, and that's the flag. Now, this isn't a reversal, it's just a pause. It's like the market is gathering energy before continuing its journey up. And of course, there's the bearish flag, which is pretty much the exact mirror image. You get a sharp move down, forming the flagpole, followed by a little upward consolidation, which forms the flag. This pattern suggests that even with that little bounce, the overall selling pressure is still very strong, and the downtrend is probably going to continue. Okay, back to our reversal patterns. Here's one of the most famous ones, the head and shoulders. It forms with three peaks. A first peak, that's the left shoulder, a higher second peak, that's the head, and then a third peak that's roughly level with the first one, the right shoulder. When this pattern completes, it's often a super powerful signal of a bearish trend reversal.
And I bet you can guess what's next. There's an inverted version. The inverse head and shoulders looks just like it sounds, an upside-down version of the pattern. It's formed at the bottom of a downtrend, and it's a bullish reversal signal, hinting that that long decline might finally be over.
All right, so now we can spot these patterns. That's great, but recognizing them is only the first piece of the puzzle. How do you actually use this information? Well, that's where our three-step action plan comes in. The key here is to be systematic. First, you identify the pattern. Second, and this is so important, you confirm it. A pattern alone isn't enough. It's way more reliable if you confirm it with trading volume. See, a breakout from a pattern on high volume shows strong conviction. A breakout on low volume? That's so convincing. And third, you determine your plan. Know exactly where you'll get in, where you'll take profits, and most importantly, where you'll cut your losses if you're wrong. Now, before you run off to the charts, we've got to cover the most important part of this whole explainer. This right here is the golden rule that separates disciplined traders from gamblers. Let that sink in for a second. Always remember that chart patterns are not absolute. They are tools of probability, not certainty. They can and they do fail. The market can show you a perfect-looking pattern and then do the complete opposite. They are a guide, not a guarantee. Never forget that. This is exactly why you never rely on just a single indicator. To really increase your odds, you need to look for something called confluence. That's just a fancy word for when multiple signals are all aligned. You combine your chart pattern with other tools, like candlestick patterns or the overall price action. When multiple signs are all pointing in the same direction, that's when your trade has a much higher probability of working out. So, we've learned that charts tell a story, we've met the main characters, and we have a plan for how to act. These patterns give us clues about the market's next chapter. So the final question is, now that you can read the story, What will you do next?